All right, guys. So today, NASDAQ, huge decline. Actually, second largest point decline in a single day of all time for the NASDAQ. Only beaten by the 2020 COVID crash. Okay? Crazy, crazy point decline. Right? Listen. 2 months ago, I posted a video on my channel, a little over 2 months ago, October 5th, 2024, saying stock market crash by December. Well, I was a bit early with that prediction, but I was basically saying, kind of basically saying by the end of the year, I was expecting the market to begin crashing. Why? Because of rate cuts, okay? Because of credit crunch, okay? If you've paid attention to some of my videos where I talk about the news inversion narrative, about how the market's a zero-sum game, about how the system's rigged in a certain way where they lead, the people who are in the know lead the sheep into the slaughterhouse and then gut them. This is applying now, okay? Because today, FOMC, they just cut rates again. Only by 0.25 basis points, right? But, and I'm no expert on when they do 0.25% versus 0.5%. Look, to me, it doesn't really matter that much. What matters is that there's rate cuts. And I've shown in previous videos that rate cuts are highly correlated with market crashes, okay? And so what I see is happening is big institutions and banks are deleveraging their bullish positions on the market. So they're selling their positions. This kind of a sell-off is not caused by retail. Now, retail may be involved in the sell-off, usually by their stop losses, by the way. So they're not driving the market down for the majority, but they're pushing it down a little bit further as they stop out for a loss on their calls or, their futures trades or their stock trades. So, but the vast majority of this move is caused by institutional selling. And honestly, I believe the institutions were anticipating this because you saw a big gap up open the other day, and I was thinking, man, this would be a great place for it to sell off from. And as you can see, that was pretty much the top. Is the open on Tuesday was the top, basically. And so now we're seeing a big sell-off. And so I personally experienced this, and I've heard that many people are experiencing this as well for the first time in quite a while, where banks are reducing credit limits. Now, banks tend to give credit out pretty liberally, and they have been doing that for the past few years pretty liberally, just increasing. I got lots of credit limit increases because they wanted to increase spending. They wanted to increase spending, and as interest rates were increasing, they collect more usury on the credit that they're providing people, right? On the flip side, rates are now decreasing. So banks are looking less to invest in interest and probably looking for other avenues to get good returns on their portfolios, okay? So they're reducing credit limits because they want to allocate their fractional reserves for other ventures. And furthermore, as rates decrease, people are going to start, well, you could argue they are going to take on more debt and stuff, but really no, okay? Because banks are allowing less debt to be made because there's less for them to gain as interest rates decrease, right? So they're reducing limits. People are paying down debt, okay? The whole way the banking system works is that for every credit, there's a debit. And when you destroy credit, you destroy inflation. Okay, that's essentially deflation. Now, we won't the whole world in this almost hyperinflationary environment rarely actually experiences real deflation for more than like a month or two, even during a market crash. But there is some deflation, and the more credit, the more loans that get paid off, the more deflation occurs. Okay, and so what we're experiencing now is definitely disinflation with probably a mild, very, very small amount of deflation. But even that small amount of deflation is enough to trigger a market crash. Okay, so you have banks deleveraging their credit, and people are going to be paying down debt. And when that happens, it causes a market crash. Okay, so what we're seeing here is the hallmark of a looming credit crunch. Now, if you're in my Discord channel, I actually was mentioning this recently. I talked about it a bit today, but about 5 days ago, I was saying credit card companies have started aggressively reducing credit limits in response to rate cuts. Signs of a credit crunch are looming, which is a hallmark of a market crash. Reduction in credit. Listen to this as well. This is another part of the whole theory and thesis. A reduction in credit slows/stagnates inflation, because what is inflation? I've talked about this before. Inflation is caused by credit, but if credit gets paid off, that inflation gets destroyed. But a lot of credit gets defaulted on, right? And so if people are spending on credit that will never be destroyed, that's permanent inflation, right? So a reduction in credit means that it slows and stagnates or even reduces the amount of credit that will in the future be defaulted on, which means that the market can't pump as easily off of, I said consumer, but also business and even government spending when they're spending with credit and or loans on the products of the companies that make up the stock indexes. The market can't pump as easily. So that means it loses momentum, and then it begins to crash. And as people start paying off their credit, that crashes the market more. It deleverages the whole system. Okay? So really important that you understand this. Okay? Because to me, this potentially is just the beginning of a major sell-off. Now, obviously, time will tell. I don't know everything perfectly, but what I see are several key indicators that foretell a market crash. And I'm not just saying this purely based on a theory. The past has actually shown this. I'm not going to pull up, actually, I could pull up, let's just pull up, let's pull up interest rates. Okay? I'm going to show you that this is correct. Okay? Watch this. Look at this. Dot-com bubble crash. What happens during the crash? Rate cuts. What happens during the ensuing bull market? Rate increases. What happens during the 2008 financial crisis? Rate cuts. Okay? Rates go to zero. Market pumps in anticipation of higher rates, among other things. Okay? And as you can see, the market pumps higher and harder when rates go up. Now, this is because it's percentage. Hold on. Maybe I can... does this work? No. It's not gonna... Damn it. It just looks highly exaggerated, but whatever. You get the point. The interest rates aren't going up like this 300% thing. They're just going up by a few percent, basis points. But anyway, look at this. Rates start getting cut. During COVID, there's a crash. Rates cut to zero. Hit zero again, market pumps. Now here, the market did sell off without rate cuts. But as you can see, actually, as it started selling off from this market crash was also caused by a cyclical 2,339-day cycle that Michael S. Jenkins talked about, which those cycles are also correlated with a lot of the major market crashes. But as you can see, they started increasing interest rates, and right after they started increasing interest rates, it slowed down a lot, and then the market began pumping again, right? Now they started cutting rates. So, and this may not look completely obvious to you at first, but essentially what happened is this summer, the market made a 17% sell-off, that's almost a bear market, but that is a massive correction, right? In about a month, it sold off really quick, right? Or no, that was about, yeah, about a month, the market lost 17%, almost 18%. Now that happened before the rate cuts, but it did happen as the rate cuts stopped going up, and there was an anticipation of rate cuts in the future. So what happened was this sell-off got ahead of the first couple rate cuts from this year, the previous 2 rate cuts, right? Then it started buying back up again. Again, with inflation and everything, the market will tend to have an uptrend, right? But now, as the next FOMC meeting came into play, people were anticipating rate cuts again, and they got the rate cuts they were expecting. I'm talking on an institutional level. So what we have here is a real sell-off caused by rate cuts, caused by disinflation, potentially a tiny bit of deflation. And what you're going to see is prices are actually going to fall. And as prices fall, guess what prices fall as well? The prices of stocks fall, right? Think about it. The whole system has taught you to think backwards about it, where they say that inflation's good inflation's bad for the market and rate cuts are good for the market. The total opposite is true. Okay, that's what they want you to believe, because in the zero-sum game, if you believe the opposite, they have to share more of their profit with you, right? Because then you're going to be piggybacking on these institutional trades that actually move the market based on the true fundamentals. Okay, it really is an opposite day type of thing. Okay, but anyway, where was I going with this? Well, but it's pretty much that simple. Okay, so now the market is selling off in anticipation of future rate cuts as well, but also in reaction to this rate cut. Okay, but in terms of prices, the prices are going to, so that's what I was trying to get at. Prices go up because of inflation. The market is the prices. Think about it. The prices, just take for one thing, for example, an Apple iPhone. The price of an Apple iPhone goes up because of inflation, right? If you adjust for inflation completely, the price of an Apple iPhone now is the same as it was when it was the first Apple iPhone. However, the first Apple iPhone cost about $700, and Apple iPhones now cost about, I don't know, $1,200 to $1,500. They cost in some cases they cost like double what they used to cost, right? But that's just because of inflation. Well, the price of Apple is tracked by the NASDAQ as well as other companies, right? And so if inflation drives up the price of an iPhone, inflation drives up the price of the whole stock price of the company Apple, right? It's actually very simple once you realize that to look at it this way, right? And think about it too. What's causing inflation? 2 things cause inflation. Government increasing currency supply by inflating the currency, like literally that's just direct deliberate inflation. And second, credit creation that will never be destroyed, meaning basically consumer, business, or even theoretically government spending, again, which is, like I already said, the government inflating, creating their own currency, but in terms of from the private sector and from consumers, spending credit that they actually never intend to pay off, and that a lot of it just gets defaulted on. Well, if credit gets defaulted on, that credit can't be destroyed, right? Because no one wants to foot that bill. If I don't pay off if I file for bankruptcy and I don't pay off my debt, do you think the company the entity who I owe my debt to, do you think they want to foot that bill? They do foot that bill in a way, but they write it off as a capital loss. But they're not going to pay off that debt. They write it off on their taxes, right? So basically, no one takes over that debt. No one pays off the debt, and it never gets destroyed. Therefore, it inflates the currency. And so any amount of debt that will never be paid off means that the currency cannot devalue back below that amount, if that makes any sense, right? So But what you have here is a reduction in credit, a reduction in banks leveraging their bull positions on these assets, and if people can't continue pumping the market with spending that they'll never actually pay off, or they won't pay off all of it, the market loses its momentum and starts to crash. And institutions, when they see signs of that, whatever it be, there's cycles in the market and human behavior, but there's also just other things going on where they just make at certain points in price levels and things like that, they just decide like, hey, it's overbought, right? People like it's going to hit a capitulation. We need to deleverage. So it does become kind of a self-fulfilling thing as well, where the banks say, okay, we think the market's going to crash, or whoever they are. I'm talking about the top traders making the calls for, their positions, like the most skilled portfolio managers and stuff like that, on the trading floors and at the trading desks for big institutions, hedge funds, like the whole shebang. Wall Street is there's lots of types of investors and traders in Wall Street, but the best ones all kind of know the same things and have the similar consensus, right? Which is to think the opposite of the herd. But anyway, so they start deleveraging from their bullish positions. They might even start to short the market, but it becomes self-fulfilling, right? So it becomes harder to pump the market, and it becomes easier for the market to sell off. Furthermore, as the market sells off, as the people who are in the know act first, and then people begin to follow them, people who are more in the know, but as you get down the ladder or the hierarchy of who's in the know about how the market works, the further along they are in the chain reaction, the less profit they stand to make from knowledge of what's actually happening, right? And then until you get to the very end of the crash, where the least informed traders pile in on the bear move, right? And they're actually at the bottom, and they're the same people who buy at the top, right? So it's sort of about who knows the most and who's the most informed about how the market works. The people who are the very most informed will act first, and the people who are least informed will act last. And the closer you are to acting last, the more closer you are to losing money or making a very little amount of profit from the market. The closer you are to being in the know fully, and the sooner you are to act based on the truth, the more money you stand to make in the market, right? But anyway, back to my main point, we're seeing sort of a disinflationary environment here, actually, as rates go down. And obviously, in the long run, inflation always continues, but the market can be very sensitive to changes in rates and decreases in inflation. Decreases in the rate of inflation, even an actual decrease, an actual decrease in the total cumulative inflation as well, not just the rate, but the rate could actually go negative, meaning that deflation would occur. And that usually only ever occurs for a month or two, even during the worst of market crashes, because it's such an inflationary world that, you can't really reduce that much credit, but maybe for a month or two there will be a reduction. There will be in cumulative credit, there will be a reduction in it. Anyway, I'm kind of going in circles, but I'm just trying to reinforce in your mind this way of thinking about the market, which is essentially the opposite of the way that most people think about the market. One other thing I want to say that really looked like a hallmark of a crash to me too is I browsed Reddit for. I try to stay away from Reddit because the idiocy and just like the absolute, like, I'm not going to try to use a bad word here, so I'm going to avoid using a bad word, but you might be thinking of the word I'm thinking. But anyway, the absolute just blank of the average mentality of like a Reddit trader or a Reddit investor is like, it's so painful to see that it's just hard to like see that for more than a couple minutes a week and maintain my sanity. But there were people across different trading Reddit boards, not just like a Wall Street Bets thing, but on the futures trading boards and all this. And I noticed that it had gotten to the point where the least informed of the people on Reddit were taking for granted that the market is perma bullish, which it is, and even I am a strong proponent of that. But however, when you see the biggest idiot on Reddit taking for granted that the market is permanently bullish, there is a higher chance that you are going to hit a capitulation in the market very soon. And I was seeing it, and that's very discretionary, and it's hard for me to like prove exactly what I'm talking about here because I couldn't go back and find the comments if I wanted to, but I just noticed that the sentiment was overly bullish. Here's one other thing as well. CNN Markets, if I can pull it up. Okay, I'm going to pull up CNN Markets. Sorry, I'm on my other tab. I'm going to pull it over on this. Okay, so CNN Markets. Look at this. Okay, so they have an indicator here, which isn't a great indicator by any means of like overall market sentiment. But sometimes what I do is I use it as an inverse indicator of market sentiment. Now, obviously, it's already saying fear, which is correct. But basically, what I'm going to point out is about a week ago, it said neutral, or even a few days ago. And what I mean by that is, hold on, I have to take this off so I can actually get around. Okay, so at this point in the market, on about Monday of this week, this said neutral. Now think about that for a second. This said neutral, right? The market is pushing all-time highs. It had one of its biggest bull days in recent history. Now there's bigger ones like this, but you know, when you have days like this where it goes up, 600 points, a day like this where it goes up like over 400 points, right? And it's pushing all-time highs, right? Now the S&P may have been a little bit of a different story, but not quite. Oh my gosh, I didn't even look at S&P yet. That's insane. But no, S&P still was in that kind of all-time high territory. It wasn't pushing all-time highs at that day, but it was still, it's around its all-time highs, right? So you have the two biggest indicators of the U.S. economy, NASDAQ and S&P, are at all-time highs. Yet CNN is saying it's a neutral sentiment. And what are they trying to go for there? Because the person at the very top, I mean, again, this may be too conspiracy theorist for some of you, and if that's the case, that's totally fine. You don't have to bear with me on this. I don't know why it's loading something, but I don't want it to change the page. All right, so anyway. Oh, I hate ads, dude. Get off. Okay, anyway. If it's at all-time highs and CNN is trying to make people think, oh, this is neutral, right? We're not even greedy yet. Like, this is just neutral. Like, it's not time to sell yet. That is when another thing. I made a mental note. I'm like, hold on. Market's at all-time highs. That would be considered. I know it does push all-time highs all the time, but usually if it's at all-time highs and looking bullish, it would be at least in the greed territory, right? If not extreme greed, right? But somehow they're manipulating the way this indicator is designed. They can get enough, basically can get enough weird correlations and stuff to make that extreme bullishness is only neutral, right? So if they're convincing the average investor who reads this that it's only neutral, it still has room to go into this territory before you would want to sell your position. Think about that. That means they're ahead of the game, right? They're ahead of the retail investors who are thinking, oh, the market's just neutral now. It's not time to sell yet. I'll sell when it gets from somewhere in the greed or extreme greed area, right? So you have to think about it. So I'm obviously not just taking one single indicator, but it's like I have so many different red discretionary, sure, but some of them plenty of the statistics backs, like the interest rate thing. When rates go down, the market tends to crash. That's just like a factual thing. You don't even have to know the fundamental reason why that's causing it, because it took me a long time to begin figuring that out. But at least just accept the correlation. Be like, rates go down, market crashes. Like, that's all you really have to know. But again, I'm taking things like that, statistically backed things like that. When they occur, it's a hallmark sign of a market crash, right? But then I'm seeing all this other stuff, like dumb idiot retail traders on Reddit taking for granted the permanently bullish nature of the market. You have stuff like this saying it's neutral when it should be a greed or extreme greed territory. It's just all just little bits and pieces here. When you combine them all together, it really paints a picture like, hey, the market's probably gonna frickin' crash, right? So now look, again, I'm not a genie. It could just end up going higher, but I'm telling you, I think the probability is right now that this is this is the start of the crash that I was calling for 2.5 months ago. Okay, so I guess only time will tell, but I'm telling you right now, it looks like this is just the beginning. Okay? Could be totally wrong, but again, I'm looking at all these hallmark signs, and what I'm seeing is it's going to get red. Okay, there's blood in the water right now, and it's just starting. So, hey, this is not financial advice. Go make trading decisions off your own due diligence, but what I'm telling you here is clearly good info in terms of like, hey, be informed, think opposite to the herd, do what you want with it. Okay, I'm not even telling you to short the market or anything, but if you're investing, maybe, well, again, I'm not going to tell you what to do, but think about it. Just think critically for yourself and think like, hey, does this really look like the hallmark of a market crash? Is this a time to deleverage, which is what banks are doing? Like, factually telling you right now, banks are deleveraging. If they are reducing credit limits of their customers, that means they're reducing their exposure to debt, right? Because if they make a loan to somebody, that person owes them that money and they may never get that money back, right? So that still matters to them. Yes, they can write it off, but that money still matters to them, right? And so if they think that we're in a system where people are about to be, not a system. If they think that we're at a point where where people's investment accounts and stuff, and this is kind of how it can become self-fulfilling. But if Wells Fargo's trading desk or their top traders think that we're in a situation where people's net worths could go, which are their net worths, which are based on their 401ks, which are tied to index funds usually, like the NASDAQ, S&P, whatever, Dow Jones, that kind of stuff. If people think the big traders at these institutions think that their customers are about to start losing money, what do you think they're going to do? They're going to reduce their risk. They're going to reduce their exposure. They're going to reduce customers' ability to spend credit that will get defaulted on. Because even though I said people they spend credit on stuff that they plan on never paying back, that doesn't mean the banks just like accepting that fact. Like, a bank has no intention of their customers defaulting on debt, right? They'll take your ass to court, they'll try to sue you, they'll send it to collections, right? Stuff like that. That said, it still happens, and the banks are definitely aware that that even the credit they give out won't get paid back on, right? But again, they don't really care because they have the power to sue your ass and get most of it back anyway, right? But again, they're not gonna keep over leveraging their credit that they're offering to people if they think everyone's about to go broke, right? Because then if everyone else goes broke and they can't pay Wells Fargo back, I'm just using them as an example, but X bank, Y bank, Z bank, whatever, any bank, they're going to reduce, if they think the market's going to crash and that people are going to be poor, they're going to reduce their exposure to the poverty of people defaulting on the credit that they're using, right? So again, it's just very big red flags are telling me like, hey, big institutions are expecting a market crash, okay? Anyway, this video's gone on way too long. It's 30 minutes. I'm sorry, didn't mean for it to be that long, but this stuff is it's interesting to me, and it gets me kind of excited, and I like talking about it. Okay, because I feel like I say things that most traders I've never really seen traders say these things that I'm saying. Very every once in a while I'll hear a trader say one or two of the things that I say, but I really don't see many people talking about these things. But to me, it's it's hidden in plain sight. It's like so obvious, but the herd just wants to think the opposite. So anyway, stay tuned, guys, and if you're interested in this stuff or any of the other ways I look at the market, remember I now have a Discord channel. My link will be in the description of this video. And yeah, this is not financial advice, but hey, welcome to my channel if you're new here, and let's figure out the market together. Come join my Discord and let me know your thoughts on this. All right, so see you guys next time, and yeah, take care.